Great. Thanks a lot, Andrea. We're a long-term partner with Franklin Madison. I think we've been doing business with your organization since 1977. We've had a great strategy and insight with you in the industry to help our financial institution partners. A quick little background on Allied. We have about 4,000 clients across the country. It's a mixture of credit unions, community banks, top 100 banks, finance companies, both consumer and auto. And we really are in the United States and in Canada. And there are some interesting things taking place. And Canada usually follows the United States in a lot of different things, regulatory oversight being one of them, but even how they lend and the whole economy. And so I'll share a little bit of insights that I've had as we kind of migrate through my presentation. I will keep it to 15 minutes to give all the other great speakers they have plenty of time. Our industry is really evolving. And I sit back and I look 10 years ago, and then I look 5 years ago where we were at. Then COVID hits. Now we've come out of COVID. And who thought that in 2019, we would be focused still on interpersonal relationships, customer service face-to-face. We were talking about lending in the future. But I think we all thought about that time that it's going to be a journey. And I think COVID got us there really quick. I'm one of the leaders in the industry that really insisted that my people come back to work, knowing that culture was equally important. And I still think culture is extremely important. I think the people side of the business is extremely important, but you can't create the margins you need. You can't create the capacity that you need, and you can't create necessarily the quality that you need by touching everything through the process. And as we start working through this evolution in the industry, there is larger and more complex solutions out there, higher demand from the consumer. If we think about the Gen Y and the Gen X folks, a lot of those don't want to be serviced and supported like the older generation. I can call myself that because I'm just a little bit past the baby boomer side, more the millennial. But the point there is now you have to blend how you service and support those people with both still maintaining a culture of kind of customization and working with the people that want to be touched and served kind of in the quote unquote old fashioned way. But you have to still be able to create the way the new people want to be treated and the way they want to be serviced. Some of them don't even want to talk or see anybody. They would rather just transact digitally and electronically. I think competition is also something in the industry that is higher than it's ever been. I think it's going to continue to create a lot of challenges for us. Especially when you look at the fintech side of things, and I'll reference the fintech in a little more detail later on in my presentation. The last thing is the strategic consolidation. And I know in the community bank side, there's consolidation going on. There's acquisitions taking place. The credit unions, very similar with the mergers and acquisitions out there. And I think that strategically, people are starting to do those acquisitions and consolidate for a couple reasons. The need for scale. The need for expense. You talk about cyber, you talk about all the investments that you have to make in order to be digitally engaged in the marketplace. You have all the compliance and regulatory oversight. It is very, very expensive. And I don't think, unless you start getting into those top 25 to 50 largest institutions in the country from a bank perspective, I don't think you can do it on your own. And I think it's really important to look at partners, leverage those partners, collaborate collectively. The demand in the consumer market and the volume and capacity that's out there today, I think there's plenty for everybody. And I think that we really need to focus on leveraging all of our resources, focus on consumer value. That's going to be a huge part of what we're going to have to do. I'll make some comments on the regulatory side a couple slides later. But there are some challenges, and I think that everybody will be up to the task, but it's going to take all of us to protect the industry, respect the consumer to make sure we're providing value, but still generate a positive bottom line. Under the current state of the industry, you have inflation. I'm not sure that we all were prepared for what happened with the interest rate margin and inflation happening so quickly. So we have a lot of ALM challenges. You have your P&L challenges. You have interest rate margin challenges out there. We're seeing a massive increase in delinquency. I can tell you in our business, we handle about 60 to 70,000 repossessions a month right now. It's higher than I've been around for 35 years. I've never seen it at this level before. Delinquencies are escalating. Regulatory oversight on how you manage those delinquencies is becoming more and more strict. We had a break during the COVID period of time where there was a lot of free money out there, a lot of flexibility on advancing due dates, protecting your delinquency, et cetera. And that's really, really started, I think, to tighten up. The lending environment, there's the liquidity challenges that are out there. But I think we're also looking, especially when you look at some of the folks that got involved in working with some of these fintechs where yields were really, really high over the last 3 or 4 years. Sometime in 2023, things started to slow down. And now we're seeing in 2024, those yields really turning totally upside down. Some of the companies look at it as a 5 or 6 or 7 year model. And what I tell the fintech partners that are out there, your story may be accurate. Your story may be accurate that over that 5 or 6 year period of time, the returns are going to average out to where you said they were. The problem is that in 2021 and 22, in many cases, they were significantly higher than what your modeling showed. And that's, that was yesterday's news when we're all looking at our returns, our profitability, our accountability to our boards. And now we're dealing with a lot of strains on those margins. And we have to find new ways to make the difference up. And like we will, there's always been solutions out there, but finding out what those solutions are, I think is the challenge for all of us. And you couple that with the lack of consumer confidence out there right now. And it keeps getting worse. I don't see the confidence builder being out there. I think we're going to be through 24 into 25 before we see consumer confidence change. You think about the emotional aspect of buying a car, for example. It usually would outpace some of the challenges that are out there, but now you have record costs of cars. In many cases, when you go buy a car, and it's starting to change, you would pay a premium for what I would call a non-off-the-shelf vehicle. Negotiating the purchase price of the car was challenging, and then dealing with the fact that we had record high in the used car market. So the values that you were lending on the portfolio that you have, if you were to take a snapshot today, you would see that you're getting higher and higher LTVs if you look at point in time. So you go back to the time of origination. You say, well, here's our policy. We were going to do 120, 125% with add-on point of sale products to create some good non-interest income revenue. But now you take and you do that same analysis, and we started to do this for financial institutions through our Deep Future Analytic company. And it's pretty frightening how upside down these consumers are on their vehicles. You add that with the increased cost of a vehicle. I think the average payment for a vehicle is $650 a month. That used to be somebody's mortgage payment. And so all of these things are kind of colliding at the same time. And I think that the uncertainty it kind of adds to the confusion and the strain that's out there. So a lot of challenges in the industry today. I don't want to be the negative person. I think you all are living it. But you add that with the competition that remains in force. I want to talk a little bit about AI. AI is here to stay, but I can tell you my company is extremely cautious. We're utilizing AI initially on how to maximize claim payment turnaround, how to do a lot of internal things that don't disrupt our client or our consumer. And as it starts to learn, because it's a brain, right? It just doesn't come out perfect day one. It has to learn through the processes. But once it learns those processes, the level of accuracy and the confidence in that accuracy continues to increase. So that means that the product and the service that you're delivering to your customers continues to enhance itself. And you're able to get, I think, a lot of efficiencies, create capacities when you do that. One of the things that are being applied in the financial institution today is call center and trying to reduce the number of calls that the call center's having to handle for a couple reasons. It's expensive and it's hard to find people to work now. I'll give you an example. In our company, we have about 1,900 employees. At any given time, we have about 100 open positions, and we're very competitive in our benefits and pay. It's just hard to find quality people that are willing to work nowadays. So you're going to need to invest in AI. You're going to need to spend a lot of money on the fintech side. That's going to be the solution, I think, that will help you reach more of the consumers, create the efficiencies that you're going to have and the margins you're need to have in order to be profitable and deliver the results that you want. And then the other thing I would say is revisit your lending strategies. There's a lot of good strategies out there. There are some proven companies that provide great default coverage on their portfolios. But you're going to need to really see where you want to play in the marketplace. Do you want to get into correspondent lending? Do you want to focus more and more on direct auto loans as an example? I think we're all learning on the indirect side, although extremely important to our portfolios, it puts a strain on your losses and your reserves. You had CECL in there where you're having to look from a regulatory standpoint on adjusting your reservings per loan on a monthly basis. It creates a lot of resource strain. And so I really recommend that you strategically kind of reset where you're at with your lending strategies. Don't stop lending, because I think now is the time where you can get some decent interest income off of it. And focus also on the non-interest income side of things, because I think those are going to be the drivers to help you get to the dollar amounts that you need from a return standpoint. Outlook in the future, and just to make sure we stay on time here, I want to just make a little comments on some of the things that the regulatory environment's doing. There was some good news on the credit card business. There was a stay in the maximum delinquency charge of $8. So that's having some court challenges. You have the exempt and non-exempt employee issue, which is going to affect your costs and expenses. That's supposed to go effect in July. That's going to have some pretty big financial hits. I know for our company, it's a six-figure plus number annually that we're going to have to absorb if it's not adjusted. You might remember when the Obama era, when they brought that to the table, it did get defeated and turned down, but it's kind of resurrected itself. And hopefully it has a more realistic solution as to where they end up. Courtesy overdraft, those of you who haven't modified how you manage that, we're in a very, very high consumer advocacy world today. The CFPB is becoming more and more active. And then you have the challenges with interchange. That is something I think that I know there's a lot of lobbyists and a lot of investment in time and energy on Capitol Hill trying to kind of pull back, because the merchant's the one that ends up on top of these things. They sure don't lower the price to the consumer. So I think those are some things that are going to create challenges. I do think that products are becoming more and more innovative. We've worked hard with our partner, Franklin Madison, in developing more and more products for you that are high in consumer value, very turnkey. And I think there's a lot of different things out there that'll help your bottom line in generating consumer value-oriented products that support what the institution's culture and goals are, and are innovative to ensure that you address Gen Y and Gen X, because I think institutions in general need to not just hand that generation over to the fintechs. I think you can invest in fintechs, you can invest in digital, but I really think that you need to invest in a strategy on how to attract more and more of those individuals into being the bank, having the banking relationships with your organization. Just wrapping up here, a couple of the unknowns I think we're going to find out, especially with the interest rate margins that are out there today. We would have thought that we would have had a couple reductions. I think the Fed's promised that we were. They've pulled back on that. I do believe that you're going to see some, obviously, it's an election year, so I would be surprised if come September you don't see some adjustments, maybe a couple of changes this year. Hopefully we can get a 0.5 point reduction and a 1/4 point reduction. I think that'll really stimulate some consumer confidence. And this regulatory environment that we're going through, you have things like refund liability. It seems like everybody wants to point to the lender as being the responsible party, even though you might not be making any revenue at all in some of these processes. The lender seems to be the target many times of the CFPB and other regulatory environments. So we almost have to keep our head on a swivel right now, making sure that we're managing and monitoring correctly how we make sure that we deliver consumer and value, but also from a regulatory standpoint, nobody wants to be on the front page of the paper or make the news. So little input from me, very engaged in the industry. I appreciate it. That was 15 minutes, went quick, but I'll be not necessarily available today for questions, but I know the Andrea's team will share any questions that might relate to me and get back with everybody immediately. Thank you very much for everybody's time. Appreciate it.